Welcome to our latest YouTube investment analysis video. In this episode, we're delving into the world of stocks, diving headfirst into the dynamic realm of investment opportunities. Today, we have a fascinating lineup of 5 companies that have piqued our interest within the Everything Money community. Together, we'll explore their financial landscapes, dissect key metrics, and discuss the factors that make these companies stand out. It's a journey of discovery, so join us as we embark on a deep dive into the world of investing. We currently have 5 stocks within our Everything Money community that are under research. I'm particularly fond of how engaged and creative our EM community is. It's remarkable how many incredible investment ideas I've discovered from the thousands of active members who share their thoughts every single day. The collaboration and idea sharing within our EM community are truly impressive, and many individuals, including myself, benefit from this collective knowledge. In today's discussion, Uncle Paul and Mo will introduce these 5 stock ideas. Let's begin with the first stock, MercadoLibre, which holds special significance for Mo and me. We have both purchased properties in Mexico through MercadoLibre multiple times. It's a commonly traded stock, so let's dive into it. Mo, what are your initial thoughts on it? MercadoLibre's current stock price is notably in the thousands, a rather unusual valuation metric in our usual investment landscape. Yet, what's truly remarkable is that this price point barely registered on my radar when I first examined the stock. This apparent indifference to the stock's price might raise some eyebrows, as stock prices are typically considered a primary focal point in investment analysis. However, my approach is underpinned by the belief that the stock's price alone doesn't necessarily convey its intrinsic value or investment potential. It is rather ironic that I casually glanced at the stock's price simply because I don't place excessive emphasis on this factor. Instead, my scrutiny was swiftly drawn to other, more substantial aspects of MercadoLibre's financial profile that warrant close examination. The standout figures that captured my attention were its price-to-earnings P/E ratio, which currently stands at 82, and the forward PE ratio of 37. These values piqued my curiosity and set the stage for a deeper dive into the company's financials. Delving into the financials revealed a fascinating narrative. MercadoLibre reported a net income of $757 million for the past year, a figure that is significantly higher than the 5-year average net income of $167 million. This discrepancy between recent performance and historical averages is a key point of interest, as it indicates a substantial surge in profitability. Furthermore, the divergence between the net income and the free cash flow was equally striking. In our investment philosophy, it's a preference for the free cash flow to surpass the net income, as this demonstrates a company's ability to generate substantial cash reserves. Another compelling facet of MercadoLibre's financial landscape is its gross profit margin, which currently stands at a healthy 50%. Comparing this to the 5-year profit margin of a mere 2.7% reveals a glaring disparity. This substantial gap between short-term and long-term profit margins raises intriguing questions. To put this in perspective, even major corporations like Amazon, boasting a vast and devoted fan base, maintain gross profit margins ranging from 25% to 40%. MercadoLibre's substantial gross profit margin suggests an enviable financial position in the e-commerce industry. In addition to these highlights, the return on invested capital, ROIC, provides further positive signals. Both the 5-year and 1-year ROIC figures indicate that MercadoLibre consistently generates a robust return on the capital deployed in its business operations. This is a critical factor, as it underscores the company's efficiency in capital utilization. However, before embarking on a comprehensive analysis of MercadoLibre's investment potential, it is imperative to engage with the investment community. This collective wisdom and diverse perspectives can offer valuable insights into the ongoing discrepancy between the free cash flow and net income. Understanding whether this disparity is a temporary anomaly or a persistent trend is crucial to making a well-informed investment decision. The community's feedback and insights will undoubtedly contribute significantly to the decision-making process, ensuring that all relevant angles are considered. Now, let's move on to the second company, CF Industries, a leading producer and distributor of nitrogen fertilizers. Mo, your initial thoughts? CF Industries has an intriguing history, but its stock price stands out immediately. It has been in the thousands, which is not typical for us. However, I found it amusing that I didn't pay much attention to the stock price because it's not my primary concern. What caught my attention was its PE ratio, which is surprisingly low, at only 7. The same applies to the price of free cash flow, which is at 8. When a stock's price is this low, it raises questions, and we should investigate its share buybacks and revenue trends. I didn't anticipate this when starting the analysis. Looking at the revenue, we see substantial fluctuations. In June, it was at a low of 60, but it's critical to note that the free cash flow exceeded the net income, which is a favorable sign. The discrepancy between the gross profit margin and the 5-year profit margin is substantial, and this is an area that deserves closer examination. Even compared to a company like Amazon, known for its broad fan base, MercadoLibre's gross margin is higher. Additionally, the ROIC for both the 5-year and 1-year periods indicates that they provide a good return on the capital invested in the business. However, given the significant discrepancy between free cash flow and net income, it's essential to engage with the community to understand the reasons behind this difference. Now, let's take a look at the third company, Tyson Foods. Mo, what are your initial impressions? Tyson Foods, as a company, presents a captivating and multifaceted financial profile that merits a closer examination. At the forefront of our analysis is its 1-year profit margin, a remarkable figure that stands at an impressive 0.6%. This metric serves as a testament to the company's ability to generate substantial profits within a relatively short time frame, making it a noteworthy aspect of Tyson Foods' financial performance. However, delving deeper into the financial landscape reveals an intriguing twist. The free cash flow, a critical indicator of a company's financial health, presents a concern. In fact, it falls below the already modest 1-year profit margin. This discrepancy between profit margin and free cash flow raises questions about the sustainability of the company's profit generation capabilities and its cash management practices. Further accentuating this point is the comparison of the 1-year profit margin with the 5-year average for free cash flow. The latter lags behind the former by a significant 20%. Such a notable variance between short-term profitability and long-term cash generation warrants a closer look. Investors would rightfully question whether this discrepancy signifies a potential issue that demands exploration. Adding complexity to the financial narrative is the sizable dividend payout relative to free cash flow. While dividends are typically seen as a rewarding gesture for investors, it's essential to ensure that they are sustainable and do not strain the company's financial resources. This becomes a critical aspect of consideration when examining Tyson Foods' dividend policies in light of its free cash flow. Despite these financial intricacies, Tyson Foods does exhibit the hallmark of a stable business model. This stability is exemplified by its consistent profit margin over the years, signifying a degree of resilience in its financial performance. Nevertheless, the underlying factors driving the substantial fluctuations in profit demand further exploration. The root causes of these variations may provide valuable insights into the company's financial dynamics. Another noteworthy aspect to take into account is Tyson Foods' high level of indebtedness. In the financial landscape, a substantial amount of debt can introduce a degree of risk and may influence the company's financial strategies and flexibility. Therefore, understanding how Tyson Foods manages its debt and its implications for the business becomes integral in forming a comprehensive perspective of the company. Tyson Foods operates within the food processing industry, characterized by its role as a commodity business. Despite the competitive nature of this industry, Tyson Foods has secured a substantial market share. This aspect highlights its position as a key player in the food processing sector, underscoring its influence and presence in a market marked by its vast consumer demand and intricate supply chains. In conclusion, Tyson Foods offers a multifaceted financial landscape, characterized by remarkable profit margins, concerns regarding free cash flow, a dividend to cash flow ratio, and a stable business model. The company's financial intricacies and fluctuations in profit, coupled with its significant debt levels, underscore the necessity for a more in-depth analysis. In an industry recognized for its commoditization, Tyson Foods has carved out a substantial market share, positioning itself as a prominent entity in the food processing sector. These factors make Tyson Foods an interesting subject for further exploration and due diligence in the realm of investments. Given the instability in profit and the lack of a clear moat, I would need to acquire this company at a very low price to consider an investment. It's crucial to understand the industry and the company's specific dynamics better, and community input can be invaluable in making an informed decision. Now, let's turn our attention to Robert Half International, RHI, a prominent player in the staffing industry. Mo, I'm curious to hear your thoughts on this one. Robert Half International boasts a fascinating history, marked by some noteworthy ups and downs in its revenue trajectory, coupled with recent declines in profitability. However, an aspect that beckons our exploration is the company's resilience during the previous financial crisis. It's worth noting that RHI did experience a setback during that tumultuous period but quickly rebounded, maintaining its profitability throughout. This historical context showcases the company's ability to weather economic storms, a valuable attribute in the world of investments. One of the standout features of RHI is its relatively high gross margin. A healthy gross margin often reflects a company's ability to generate profits after accounting for the cost of goods sold. What adds to the intrigue is the outlook offered by analysts, who anticipate significant increases in profit over the coming years. This projection hints at a promising future for the company, making it all the more captivating. To delve deeper into our analysis, it's essential to examine the company through the lens of the 8 pillars. The current price to earnings (PE) ratio does appear to be on the higher side, raising questions about the company's valuation. Similarly, the price of free cash flow is also seemingly expensive, another aspect that warrants consideration. However, it's vital to recognize that Robert Half International operates within the staffing business, an industry known for its unique dynamics. While the current valuation metrics might raise eyebrows, it's crucial to remember that staffing businesses often exhibit stable profit and revenue trends over the years. An encouraging facet of our assessment is the remarkably low level of debt that RHI carries. Low debt levels contribute to a company's financial stability and flexibility. In this regard, Robert Half International stands out as a company with minimal debt, further enhancing its financial soundness. From a market perspective, the company's market capitalization currently stands at $8 billion, while the enterprise value is $8.8 billion. Domino's Pizza is a well-known brand, but it's not necessarily a business with a strong moat. It's in a highly competitive market, and there are plenty of other pizza options available. The company's stock has seen a significant dip recently, falling by half. This presents an opportunity for potential investors. The stock's value is important to me, and I'm always looking for an attractive entry point. The great thing about investing is that you have numerous choices, much like choosing a place to dine. If your favorite restaurant offers a significant discount, you'd consider giving it a try. Similarly, when it comes to investing, the right price can make any investment appealing. So, I'll be keeping an eye on Domino's Pizza and monitoring the community for insights and opinions. In conclusion, these are the 5 companies under consideration within our Everything Money community. We encourage you to join us on our platform and take advantage of the 7-day free trial to explore the community, utilize our tools, and engage in discussions. Making informed decisions in investing requires being part of the community and accessing the wealth of knowledge and insights it offers. Visit everythingmoney.com to learn more. And there you have it, our insightful analysis of these 5 intriguing companies within our investment community. We hope you've gained valuable insights and discovered new perspectives on these stocks. Remember, investing is an ongoing journey, and making informed decisions is crucial. So, whether you're a seasoned investor or just getting started, don't hesitate to join our community, engage in discussions, and access powerful tools at everythingmoney.com. Stay informed, stay inspired, and keep exploring the world of investment opportunities. If you enjoyed this video, please like, subscribe, and hit that notification bell for more enriching content. Thank you for being a part of our investment journey, and we'll see you in the next video.